If there's one company that defines financial power in America, it's JPMorgan Chase. And in 2025, that power is on full display. While many banks are tightening their belts and warning of loan stress, JPMorgan just posted another record-breaking profit, driven not by luck, but by strategy. The secret? A masterclass in what Wall Street calls net interest income, the spread between what a bank earns on loans and what it pays on deposits. In other words, JPMorgan has found a way to turn America's high-interest rate environment, something that hurts many, into a money-printing advantage. This is the story of how JPMorgan is doing it, what's driving its profit playbook, and why its approach might just define the future of U.S. banking. 1. The setup, the high-rate paradox. When the Federal Reserve raised interest rates to fight inflation, most businesses felt the pain. Borrowing got more expensive, investment slowed, and regional banks started wobbling. But for giants like JPMorgan, it was the perfect setup. That's because higher rates widen the gap between what the bank charges on loans, mortgages, credit cards, corporate financing, and what it pays customers for deposits. That difference is called net interest income, or NII, and it's the heartbeat of bank profitability. In the third quarter of 2025, JPMorgan reported nearly $25 billion in NII, up sharply year over year. That single line item accounts for the bulk of the bank's record profit. In plain English, JPMorgan is earning more from lending while managing to pay out relatively little more to depositors. 2. The profit engine, precision in balance sheet strategy. So how does JPMorgan pull this off? It comes down to scale, strategy, and sophistication. First, scale. JPMorgan has over $3.9 trillion in assets and serves nearly half of all U.S. households. That gives it enormous flexibility to manage liquidity, loans, and pricing in ways smaller banks can't. Second, strategy. Unlike regional lenders that rely heavily on fixed-rate loans, JPMorgan structured its portfolio to adjust dynamically with the Fed's rate hikes. That means when rates rise, JPMorgan's earnings rise too. Third, sophistication. The bank uses advanced analytics and AI models to optimize where and how capital is deployed, from corporate loans to treasury operations. Every percentage point in yield counts, and JPMorgan's treasury division has turned yield management into a science. 3. Beyond interest, trading and investment banking come roaring back. It's not just lending that's driving profits. JPMorgan's investment banking and trading divisions are back in top form. With market volatility returning and deal activity rebounding, the bank's trading desks, especially in fixed income and commodities, posted huge gains. Meanwhile, its investment bankers are benefiting from a resurgence in mergers, IPOs, and debt issuance as capital markets reopen after 2 sluggish years. Together, these businesses form the second leg of JPMorgan's profit machine, counterbalancing any future decline in interest income when the Fed eventually cuts rates. In essence, JPMorgan has diversified its profit drivers: interest income for today, market momentum for tomorrow. 4. Digital dominance, the silent profit multiplier. Here's the part most people miss. JPMorgan's quiet digital transformation has become a profit multiplier. Over the last 5 years, the bank has invested billions in AI, cloud infrastructure, and fintech integration. Its AI-powered risk management systems allow it to process real-time data from global markets, spotting threats and opportunities before competitors. Its digital retail banking platform, Chase, now handles more than 70% of customer interactions online or via mobile. That shift cuts costs dramatically while increasing engagement. And through automation, JPMorgan can process loan approvals, compliance checks, and customer inquiries faster and far cheaper than before. This is not just modernization, it's margin expansion through efficiency. 5. The secret sauce, risk discipline. Jamie Dimon, JPMorgan's legendary CEO, is famous for saying, "You can't control the economy, but you can control your risk." That's been his mantra for nearly 2 decades, and it's exactly what's keeping JPMorgan stable while others wobble. The bank's loan loss reserves remain strong. Its exposure to commercial real estate, a pressure point for many regional banks, is tightly managed, and its capital ratios far exceed regulatory minimums. In short, while others stretch to grow, JPMorgan protects to sustain. That's why investors trust it, and why in times of market stress, depositors move toward it, not away. 6. The bigger picture. Why JPMorgan's model matters. JPMorgan isn't just winning for itself, it's shaping how the rest of the industry behaves. Other large U.S. banks are watching closely, trying to replicate its multi-engine profit model: interest income from flexible lending portfolios, non-interest income from trading, payments, and advisory, digital efficiency that lowers costs while scaling reach. In an economy defined by uncertainty, from trade tensions to AI disruption, this kind of balance is priceless. It's why JPMorgan stock continues to outperform nearly every peer. 7. The Fed factor: what happens when rates fall. Of course, no profit playbook lasts forever. When the Federal Reserve eventually cuts interest rates, JPMorgan's NII will likely shrink. But the bank has prepared for that. Its investment banking pipeline is strong, its digital channels are expanding, and its asset management arm continues to bring in steady fee income. In other words, the short-term windfall from high rates is being reinvested into long-term diversified profit engines. That's not reactionary banking, it's strategic evolution. 8. The Dimon Doctrine: play offense in a slow economy. Jamie Dimon's leadership philosophy is deceptively simple: invest when others retreat. While competitors froze hiring or scaled back, JPMorgan kept expanding into AI infrastructure, wealth management, and even overseas consumer markets. That's because Dimon knows profitability isn't just about cutting costs, it's about building resilience. When the next downturn hits, JPMorgan will already have the digital tools, customer base, and capital muscle to accelerate while others pause. That's the ultimate profit playbook. Not reacting to cycles, but building a model strong enough to thrive through them. 9. The broader message: profit through prudence. In an age obsessed with disruption and growth at all costs, JPMorgan's story is a reminder that profitability still begins with fundamentals: price smartly, manage risk aggressively, diversify revenue streams, use technology to amplify efficiency. That's not flashy, it's disciplined. And discipline, not hype, is what builds trillion-dollar institutions. 10. The takeaway: lessons from the Profit King. JPMorgan's record profits aren't just numbers, they're proof that stability can be strategy. While others chase hype cycles or slash budgets, JPMorgan plays a longer game, leveraging data, diversification, and discipline to make volatility work in its favor. The result: a profit machine that keeps humming even when the world around it stalls. Because in modern business, success isn't just about growth, it's about profitable growth. And in that game, JPMorgan is showing America how it's done, one quarter, $1 billion at a time.